Swayam Prabha. Digital India. Educated India.
In this presentation, we will discuss how FDI and FII in infrastructure is again one of the issues in the development of new infrastructure, and also how this particular foreign assistance is required when we are having large demand of infrastructure and the conditions to fulfill those demand as soon as possible. Let me begin with the brief outline of this presentation. We will discuss in brief what is basically the foreign direct investment. We will also discuss what is institutional investment, foreign institutional investment. Then I will try to establish the link between the FDI in infrastructure and again FII in infrastructure, and then we will discuss little bit about what is basically current capital account convertibility and its role in infrastructure development. Let me start with what is basically the foreign direct investment. FDI is one of the most today one can say that FDI is the most controversial and most debatable topic all over the world, especially in developing country and least developed countries, where when the multinational corporations are investing their fund and FDI is coming directly in the production business. There are so many uncertainties, there are so many questions in the public mind, and it is indeed important to understand what is basically the FDI and how it is going to influence the production and how it is going to really create uncertainties, and whether those questions and uncertainties are really existing in the world or it is just the fear of the public. So, FDI is basically a category of international investment that reflects the objective of a resident in one economy obtaining a lasting interest in an enterprise resident in another economy. So, FDI is basically the investment which is which flow from one country to other country, and if it is if a country is receiving that investment, that is basically the FDI inflow. But the moment a country is basically not having that investment, somehow the investment is going back from the economy, and that is not basically inflow, but it is the outflow of the economy. Lasting interest implies the existence of a long term relationship between the direct investor and the direct investment enterprise. So, why the investor will come? The investor will come because certain interest of that investor, and that interest is the interest in terms of producing directly in certain enterprises, and a significant degree of influence by the investor on the management of the enterprise is always seen. It depends on what percentage of FDI is coming in that particular sector. If government is allowing 100% FDI in a particular sector, the entire decisions will be taken by that particular investor, because when the investor is the bulk investor, when investor is the full investor, then they will not allow varieties of other divergence in the policy decisions. They will try to influence the enterprises management and completely try to have their own influence. But if the investor is in a very small percentage, suppose if it is 20%, 15%, 10%, 7%, then in that case the investor is a basically partial investor, not the full investor, not the final investor, but the other local investors are basically taking care of the entire management of the enterprises. In that case, foreign investment is not going investor is not going to influence the decision of the local industries or the domestic industries, because they are not really the bigger partner, they are basically the small partner. So, a direct investment relationship is established when the direct investor has acquired 10% or more of the ordinary shares or voting power of an enterprise abroad. This is the IMF balance of payments manual's discussion, that if it is more than 10%, then certainly it is not the ordinary share, but the relationship is really established between the investor and the enterprises. Coming back to the discussion on another aspect of investment, and that is another part of the investment, that is foreign institutional investment, which is not directly coming to the country, but it is through the different indirect way, and it means that investment by an institution established or incorporated outside a country, which proposes to make investment in the securities of that country. FII is not really the direct investment, but it is a indirect investment through the established institution of that particular country, which provide the security of the investment on a particular investor, and that includes the investment in insurance companies, pension funds, mutual funds, foreign central banks, commercial banks, university funds, charitable funds, and different foundations. So, it is not the investment which basically comes and directly influence the production process, but it is through the different institutions which a country is establishing to get the investors to get the investment in the form of different funds and shares, and ultimately that type of investment is not the investment which directly start producing the things, but it is indirectly influencing the production process. The foreign institutional investments, as we have discussed, that includes pension funds, mutual funds, investment trust, banks, insurance companies, foreign central banks, foreign government agencies, wealth funds, international multilateral organization agencies, university funds, and varieties of other serving public interests such as charitable trust, foundations, and endowments. So, these are the broad category of foreign institutional investment. Now, going back to the linkage between the FDI in infrastructure, investment in infrastructure has seen as a continuous surge since 2000, including both domestic as well as the foreign investments. A recent study by the UNCTAD shows that developing world has a share of 65% of the world projects investment by value, while its share in number of projects accounted for 51% over the past decades. Within developing and transition regions, the largest inward FDI stocks in infrastructure in 2010 were in Asia, and that was basically in the field of transport, storage, and communication. If one can see some of the countries as an example, the share of infrastructure in total FDI in 2010 in Kenya was 31%, Morocco 35%, Pakistan 24%, and Philippines 14%. This is one of the indicators that how a country is really getting the part of FDI in infrastructure. We will have a separate discussion on FDI in India also, especially in infrastructure, but let me also discuss some other points. This is one of the graph which includes the FDI investment in infrastructure. The green line shows the investment in telecommunication, while the blue line is the total investment, and the other line is electricity, gas, and water, investment in electricity, gas, and water. We are finding here the largest investment, and this statistics includes the investment in around 83 countries of the world. This is the UNCTAD data which includes the FDI inflow in infrastructure. And we find out that especially in telecommunication, there was a peak period of investment in total of 83 countries, and that investment was huge between 1988 to after 1988 to 2002. Still we find out that there are certain investment going on in telecommunication, but there is a declining trend in investment in recent years. While in case of electricity, gas and water, we are finding that during the period when the investment FDI investment in telecommunication was on peak, there was also surge of investment in electricity, water and gas, but at the same time the current rate of investment in water, gas and electricity is much higher than the current rate of investment in telecommunication infrastructure. So, in total we find out that because of the peak period of investment in telecommunication, the total infrastructure shown in the blue color here, the graph shows the highest level of infrastructure development, especially in telecommunication after 1998 to 2002, or the peak period is 2001, but at the same time there is a drop because of the drop in the telecommunication sector. So, telecommunication is undoubtedly in this example one of the major area of investment, and whenever telecommunication has dropped, we find out that compared to telecommunication, the investment in gas, water and electricity is less, but the recent trend shows that after 2006, the recent trend shows that the investment in electricity, gas and water is much higher than the investment in telecommunication. Now, India as an example of one of the reformed economy, which we have discussed in the previous presentation, we can find out that how FDI in India is allowed in different sectors. In case of airports, in the greenfield projects it is 100%. Greenfield projects are those projects in which no facility, no infrastructure is established before, but the existing projects are those projects which has previously developed some infrastructure. So, in that case only 74% FDI is allowed, but in case of the new airports coming up or the complete new infrastructure is being developed, in that case 100% investment is required. So, in case of industrial parks 100%, telecommunication 49% by automatic route, railway 100% telecommunication services, India can also allow 100% investment in telecommunication, but by automatic route only 49%. For rest of the investment, investor has to take permission from the government. Railway infrastructure 100%, construction development projects 100%, exploration activities of oil and natural gas 100%, private sector banking 74%, public sector 20%, and compared to this, there are certain prohibited sector where government is not really allowing the foreign direct investment, such as lottery business, gambling and casinos, chit funds, Nidhi company, trading in transferable development rights, real estate business or construction of farmhouse, manufacturing of cigars, cigarettes and tobacco. Activities sectors not open to private sectors are basically automatic energy and railway operation. So, still we find out that there are certain areas where India is not allowing any foreign direct investment compared to the areas which we have developed, such as the airports, railway, telecommunication, construction development and exploration activities of the natural gas and banking and industrial park, where the FDI is allowed. Let me also discuss briefly that what percentage of shares FDI in different sectors as percentage of total FDI inflow is available in this particular diagram, and we find out that the service sector and construction infrastructure are the leaders. Telecommunication is the third one, computer software hardware is the fourth one, drug and pharmaceutical and chemical sector is the fourth one. But if one can see the power at the same time, telecommunication, India is not really having a large share of FDI coming up because of the previous cases of FDI in power sector, investors are still not really convinced that whether we should go for investment in power sector or not. So, majority of the service sectors such as banking, insurance and other sectors, we are having some percentage of investment, but the construction infrastructure and telecommunication are not really the one which can really give India a better future in infrastructure. So, India lack infrastructure investment, especially in power and other sectors, which is more important for India to achieve. One can also see here the FDI in infrastructure in 2013, where the air transport sector has the first largest FDI in infrastructure. Air transport sector has not the highest, but the highest infrastructure sector is the non-conventional energy sector, and then we have the hospital and transport, hospital and power sector as a part of infrastructure investment. We do have construction development as one of the largest in terms of infrastructure, FDI in infrastructure. So, we do not have as much infrastructure, as much FDI available in telecommunication as it was available in the construction development in 2013. So, the trends of infrastructure investment shows that it is not, the FDI in infrastructure is not as per the need and the possibilities of getting the infrastructure by India, but as per the investors need, as per the investors requirement, not as per the country's requirement. So, we need investment in power, but the major investment is in the construction development. We need investment in telecommunication, but the investment in telecommunication is very less. It is almost half of the power investment, FDI investment in 2013. So, these indicators are not the good indicators. In case of FII, foreign institutional in infrastructure sector, the data from the SEBI, Security Exchange Board of India, we found that the majority of the foreign institutional investment is received in the oil and gas sector. Then we have the second foremost important sector to receive FII is the telecom sector and transportation sector, but other sectors such as shipping, surface transport, marine ports and healthcare, hotel and restaurants, in these sectors the institutional investments are not really having a very impressive results. Let me also discuss briefly that how this controversy of full convertibility on capital account is linked with the foreign institutional investment, and how the foreign institutional investment FII is again further linked with the infrastructure development. So, what is basically capital account convertibility? Full convertibility, it basically when the capitals are received through the institutional sources like the FII. If a country is having full convertibility on capital account, then whatever investment is available in a country, the investors are secure that that investment will anytime will be convertible and investor can go back from the economy. India has not allowed the full convertibility on the capital account. Capital account are those accounts in which we have the calculation of the investments and varieties of capitals which is inflow and which is having the inflow and outflow in an economy. Current account includes the export and import and other transactions, and India had full convertibility on current account. So, the exporters and importers are having much better conditions, It was not available in India before 1991 because of the trade policy reforms. Now India is having 100% convertibility, full convertibility on current account, but at the same time International Monetary Fund and other international agencies are also pressurizing India for last many years that you can also have the full convertibility on the capital account. So, the full convertibility on the capital account India is not ready to accept because what is basically the capital account is nothing except the freedom to convert local financial assets into the foreign ones at market determined exchange rates. It leads to the free exchange of currency at lower rates and an unrestricted mobility of the capital. So, a capital invested in a country is free to move out when the investor feels to move out. There will not be any problem in the currency exchange. So, beneficial for a country because inflow of the capital investment increases. Any economy, and one cannot forget to cite here the example of the Asian countries before 1997, which has received a huge capital especially through the foreign institutional investment, and the moment they were having certain problem in the economy because these East Asian countries were having short term debt from the international lending agencies, and average debt was calculated more than 80-90% of the GDP. In some of the country the debt GDP ratio was above 90%. So, when the matter reached to the investor thought that this is not the economy to sustain, this is not the economy to continue for the investment, and they have started running out from the Asian markets. And in 1997, before 1997, many economists and various studies were treating Southeast Asia as one of the Asian tigers, and soon after the crisis started, these tigers had no face because they were having full convertibility on the capital account. Since they were having the full convertibility on the capital account, a large pool of investment they have received, there were many hopes in the economy that through these investment they are going to get certain better result, but finally when the investors started flowing out from the country, they were not in the position to really face the new challenges, and the new challenges was the complete disaster in terms of economic development. So, the flip side of this full convertibility on capital account, it could destabilize an economy due to the massive capital flows in and out of the country, and that happened in 1997 in case of East Asian crisis. So, India has full convertibility of rupee in the current account, but has limited convertibility on capital account, and due to this fact many institutional investors, they do not want to really look for India as the prime destination, because they are not really certain, and they are very much sure that their entire investment they are not waiting to have full exchange at their wish, but they will have only a certain percentage of investment in their hand in case of any bad conditions of the economy. So, if one can see the investors interest, investor wants those economies where they have the full convertibility on their investment, full exchange of their investment. But when a country is not having such policy to have the full convertibility of the investment, in that case investors are really worried that what will happen in case of any crisis of that economy, and that way India is treated as one of the safe economy. Even during the financial crisis, recent financial crisis, much impact is not on India because we were not having full convertibility on the capital account. But at the same time investors are not really giving a very positive remark on the Indian economy, because India is not allowing them to have a complete convertibility on their investment, and in absence of that investment, a lot of infrastructure investment which is not really direct investment, which they are treating as the indirect investment through the institutional investments, are not really reaching to the country. Foreign investors can invest in infrastructure and other sectors without any barrier if a country is having capital account convertibility, because a partial convertibility is one of the barrier for the investor, and as an investor one is only looking for what they are getting from the market, because investors wants return, and the return is not possible when there are uncertainties and when the economy has certain crisis. So, constraint on domestic investment in infrastructure can be relieved through the capital account convertibility. So, majority of the projects which lack today in terms of getting the funds from the various companies, it is not really possible without having the full convertibility of the capital account, but at the same time attracting foreign capital for mega power projects and highway projects are possible with certain risk on capital account convertibility, because if India allow for the full convertibility on capital account, it is a fact that India will receive a much large pool of infrastructure funds and investment from various parts of the world, but at the same time those investments will be again one of the risky investment, because we are not sure that how long that investment is going to continue if there are certain risk India is facing or any developing country is facing. So, urban infrastructure and smart cities development, which is the smart city development, is one of the agenda of the current government today, and it is not possible to have the resources for this type of development as indicated by various investors investment body, then that India, a country like India, if they are not really opening up the economy further, like they are arguing that not having the full convertibility on capital account is basically the drawback on the economic liberalization on India, economic liberalization of India. So, India should and India must do this full convertibility on capital account, but at the same time the risk calculation is again one of the major issue after taking care after taking lessons from East Asia and taking lessons from the recent financial crisis. It is indeed important to really have a relook on the capital account convertibility, because this type of capital account convertibility, full convertibility on capital account is really helpful when we are looking for more and more investment, but it is really shocking when a country is facing certain imbalances. Imbalances may be the economic imbalances, and imbalances may be the political imbalances or the social imbalances. So, to conclude the entire discussion, if we can see here that FDI and FII has a very prominent role in infrastructure development today. Any developing country or which has high potential to grow, it cannot really work, it cannot really grow faster today without the help of the FDI and FII. Varieties of a large pool of literature is available on how FDI and economic growth is interconnected, but at the same time the studies on full convertibility on capital account do show that as long as countries are not really having a better macroeconomic indicators, any such full convertibility on capital account is going to lead us into a new disaster. So, taking lessons from the past and present, the fact is that foreign institutional investment or direct investment is required, but at the same time we cannot really grow up without these investments. A proper regulation of the government policy, a proper regulatory environment for receiving such infrastructure funds is indeed important today, and India must find out the new challenges in receiving those infrastructure related funds, whether it is through the institutional or whether it is through the direct investment. I think this discussion gives you an idea that how government policy on investment is influencing the receiving of certain infrastructure funds, and if government policy is really having the new way of liberalization, new economic reforms on the way, then certainly we will get some more funds, because infrastructure development is impossible without receiving the international funds. Thank you.